Welcome back, students. We ended the last video going over brief exercise 12.6. So we will pick up there in this video. Right here in this little box, they comment, one key difference between international standards and U.S. standards, IFRS does not allow the fair value option as U.S. GAAP does. So in certain cases, fair value option is not available under IFRS. It is always available under US GAAP unless consolidation is required. So we'll get to that with equity investments here in a little bit. But let's move on down. So the concept review exercise, I encourage you to go through these in great detail. They'll really help you understand the principles. I don't ever go over those because I just don't have time. And I think they're better if you go over them, sit down, look at them, make sure you understand exactly what's happening and why you do it that way, and go over it until you can do those entries on your own without looking at them. And I know you may memorize them. Don't rely on that. Say, okay, I know what happens. Here's why it happens. That why is critical. Okay, so we will move on through that. And we get to financial reporting and disclosure related to debt securities. And remember, we have three categories: trading securities, held to maturity, and available for sale. And the reporting is down here. Certain things that always have to be reported: aggregate fair value, gross realized and unrealized holding gains, gross realized and unrealized holding losses, change in net unrealized holding gains or losses, amortized cost basis by major security type. The notes also have to disclose the fair value hierarchy levels that are used. And you may be saying, what are those? Well, they were in chapter 1 that you covered last semester in accounting information systems. We will go over chapter 1 again at the end of the semester. But just to remind you, we'll look at it again here in just a minute, but other things that have to be shown, disclosed: total gains or losses for the period, purchases, sales, issuances, settlements, and transfers in and out of the level 3 category, which is basically, what do I think it's worth? Okay, so notice the page number here. We're going from page 668 down to page 29. This is from chapter 1 of this textbook, and it covers the fair value hierarchy. And so there you see level 1's quoted market prices, basically for that security or that bond. Level 2 is some sort of fairly reliable quoted price for similar bonds. When we get into tangible assets, that can be blue book value for vehicles or comparables for real estate, things like that that are observable. And then level 3 is the unobservable. Again, kind of looking at it saying, here's what I think it's worth. So that is the fair value hierarchy. What you have from each of these categories has to be disclosed for bonds. Okay, now we move down to accounting for equities. Now, accounting for equities, there are 3 methods. You may be saying, okay, that sounds familiar. I know what they are: fair value through net income, fair value through other comprehensive income, and held to maturity. Well, no, that's not the 3 categories for equities. In fact, only one of those 3 applies to equities. There's no held to maturity because there is no maturity date for equities. The available for sale category no longer exists for equity securities. So equity securities have to be accounted for in one of three ways. One way is fair value through net income. So unrealized holding gains and losses must go through net income. The second way is, and the equity method, right down here, they disclose those to you. So there you have fair value through net income. Now the equity method you use if you have the ability to exercise significant influence, but you don't have control. Now, generally to have control, you need to have 51% or more than 50%. Now, some cases you may be able to exercise effective control if the ownership is significantly diverse with less than 50%, but consolidation is a third type. Generally speaking, you don't consolidate financial statements. That means you combine the two companies together as though they were one company, parent-subsidiary view, with a consolidation. Consolidations will be covered in advanced accounting if you take it, and it is tested fairly heavily on the CPA exam, something very important. The main reason I emphasize to students you should take advanced accounting because consolidations is not something you want to have to try to learn on your own. But anyway, the equity method use if you have the ability to exercise significant influence, but you don't have control. Now, if you don't have the ability to exercise significant influence, then you use fair value through net income approach. Now, US GAAP does allow for using fair value through net income as opposed to the equity method where you have significant influence but not control. International GAAP does not allow that. Okay, now your book gets into the discussion of when an investor has significant control, when an investor doesn't have significant influence, use the fair value through net income approach. That's basically the same way we treat trading securities for debt securities for bonds. So the entries are pretty similar, not really a whole lot of difference there. And again, that generally happens if the owner owns less than 20%. Now, there may be cases where an owner can demonstrate that they can exercise significant influence even though they have less than 20%. If, for example, your company gets a seat on the board of the other company, let's say you own 15%, but your company gets to have one of its officers have a seat on the board of the other company, then that would be evidence of significant influence. So, especially with extremely large companies like say a Chevron or 3M, excuse me, something like that, the ownership is so diverse that if you owned 15%, you would certainly be in a position to exercise significant influence. If you owned 15% of the stock of Chevron and you call the chairman of the board's office and said, I'd like to speak to you about something dealing with the company, I suspect they'd take your call. If you own a couple of hundred shares and you call, they'll send you to investor relations. So that's the concept of significant influence. Again, if you're not in a position to exercise significant influence, then the investment is accounted for at fair value through net income. All adjustments in fair value get reported in net income as gain or loss. Okay, and you see There's the journal entry when you purchase the security. There is receipt of dividend when you are recording, accounting for it according to fair value at through net income. So when you receive a dividend, you debit cash, credit dividend revenue. When there are adjustments, here we had a loss, so we debit loss on investments, net income, and then the fair value adjustment. You remember that. So in 2021, they had a decline in value of $50,000 on this particular investment. Then they sell the investment the next year. They paid $1,500,000 for it, I believe. Yes, right here when they purchased it. So it declined by $50,000 that year. So now it's recorded net of the fair value adjustment at $1,450,000. And they sold it for $1,446,000. So we had an additional decline in value of $4,000 more. So we have to record that adjustment. Again, a loss going to net income. So the fair value adjustment now has a credit balance of $54,000. So then they sell the stock for $1,446,000, debit cash for the amount received, debit the fair value adjustment for the $54,000 balance that it has, and then credit the investment for $1,500,000. You can see right here, these two remove everything related to the investment from the books now. So okay, they're just adjusting some other accounts to investments to fair value. Now, here they get into a discussion, what if fair value is difficult to determine? And that's where you get into the valuation hierarchy. I'm not going to really spend time with that. The IFRS, again, they do have a category of basically available for sale in international standards. We used to have that in US GAAP. It was eliminated. I believe the standard came out in 2016 that eliminated it. It was a few years before it was implemented, maybe effective in 2018. It is now fully implemented, and so there is no available for sale treatment of equity securities anymore in US GAAP. Financial statement presentation. Again, the investment gets classified as either short-term or long-term, depending upon management's intention. And on the balance sheet, it gets reported at fair value, though. In either case, statement of cash flows for trading securities, generally speaking, they get reported in operating activities. If management's intention is more like available for sale type securities, then the buying and selling would get reported in the investment section, investing section, investing activities, and receipt of dividends is treated as an operating activity. We have these two homework problems to go over, but we'll have to do that on the next video. So I will stop there and we'll begin the next video with brief exercise 1210 and 1211.